Have you ever wondered why some traders make a killing in minutes while others blow their accounts just as fast? Stick around because I'm about to break down scalp trading, using a simple dice game that shows exactly how it can be the quickest path to big wins or total wipeouts. Alright, so let's dive right in. Scalp trading is basically this super fast way of buying and selling stuff like stocks, forex, or crypto to grab tiny price moves. We're talking holding a trade for maybe seconds up to a few minutes, not hours or days like other styles. It's all about speed. You spot a small edge, jump in, snag a quick profit, and get out before things turn sour. But why explain it with dice? Because dice make it crystal clear how randomness and quick decisions play into this, and it ties right into self-improvement by teaching you about risk control, staying calm under pressure, and building habits that help in trading and everyday life. Think of it as a lesson in not letting emotions run the show, which is huge for anyone trying to level up their mindset. Now, the big problem with scalp trading is that it's insanely risky if you don't know what you're doing. Imagine you're at a casino table, but instead of fun money, it's your hard-earned cash on the line. The challenge here is the market's unpredictability. Prices can zip up or down in a blink due to news, big players moving money, or just random noise. Without a solid plan, you're basically guessing, and guesses lead to losses that stack up quick. I've seen people start with excitement, thinking they can outsmart the market every minute, only to end up stressed, broke, and questioning their choices. It's not just about losing money. It's about the mental toll, the constant screen time, the adrenaline rushes that mess with your sleep, and the bad habits that spill over into other parts of life, like impulsive decisions at work or with friends. The real challenge is mastering the discipline to stick to rules when everything feels chaotic, which is where self-improvement comes in. If you can handle this, you build resilience that helps you tackle tough goals anywhere. Let's explore this deeper by using the dice analogy to make it all click. Picture a standard six-sided die, fair, random, each side from 1 to 6 equally likely. In scalp trading, the market is like rolling that die over and over, where each roll represents a tiny price fluctuation. Your job as a scalper is to bet on whether the next roll will be high or low, but with a twist. You have to decide super fast, and you're aiming for small edges, not huge jackpots. First off, think about probability. With a fair die, the odds of rolling a 4, 5, or 6, let's call that a win for going long in a trade, are 50 to 50 against 1, 2, or 3, a loss for shorting. But in real trading, markets aren't perfectly fair. There are patterns like trends or support levels that give you a slight edge, maybe 55% win rate if you're good. So in our dice game, imagine the die is slightly weighted to favor higher numbers during an uptrend. As a scalper, you'd bet on high rolls more often. But here's the catch. Even with that edge, one bad roll can hurt, and a string of them can crush you. That's why position sizing is key. Never bet your whole stack on one roll. In trading terms, risk only 1% of your account per trade. If you bet too big, like putting half your money on a single dice roll, a few lows in a row wipe you out. I've tested this mentally. Roll a die 10 times, betting double each loss like a martingale strategy. Sounds smart, but in practice, a losing streak of 5 or 6 rolls, which happens more than you think, leaves you broke. Scalp trading amplifies this because trades happen so fast. You might do 50 in a day, turning small mistakes into big disasters. Now, let's develop this idea with some real-world examples. Say you're scalping Bitcoin. Price is hovering at $60,000, and you see a quick dip to $59,950 on low volume. That's your signal to buy, expecting a bounce back to $60,020 for a $70 profit per coin. But if news hits, like a tweet from a big influencer, the price could tank to $59,800 instead, and you're out $200. Back to dice. It's like rolling for a 5 or 6 to win, but sometimes the table shakes, news event, messing up the odds. To improve, you need tools like charts with 1-minute candles, indicators such as RSI to spot overbought conditions, or moving averages to confirm trends. In self-improvement terms, this is about preparation, just like practicing a skill daily to get better at it. Spend time backtesting strategies on historical data, not jumping in blind. For instance, look at past charts. In a bull market, scalping pullbacks works 60% of the time, but in sideways chop, it's closer to 40%, so you sit out. Discipline here means walking away when conditions suck, which builds patience in life too, like not snapping at someone when you're frustrated. Another layer, emotions. In dice terms, after 3 losses, you might start betting bigger to catch up. That's revenge trading, and it's a killer. Markets don't care about your feelings. They're random like dice rolls. To counter this, set strict rules. Max 3 losses in a row, then stop for the day. This self-control translates to better habits, like sticking to a workout routine even on bad days. Also, think about fees. Each trade costs a bit, like the house edge in a casino. In dice, if you pay 1 cent per roll, it eats into profits over time. Same with trading commissions. Scalp too much and even winners net less. Aim for high probability setups only, maybe 10 to 20 trades a day max. As we build this out, consider the setup needed. You need a fast broker with low spreads, like for forex pairs such as euro to US dollar where pips are tiny. Practice on a demo account first roll that die hundreds of times in your mind or on paper to simulate. Track wins/losses. If your win rate dips below 50%, tweak your strategy. For self-improvement, journaling helps after each session. Note what went wrong, like, I entered too early on that fake breakout, and fix it next time. Over months, this turns you from a gambler into a calculated risk taker. Heading into the key moment. The climax of understanding scalp trading with dice is realizing it's not about winning every roll, but surviving long enough for your edge to play out. Picture this scenario: you're down after 5 bad rolls, account at 70%. Do you quit or double down? The smart move is quit, review, come back stronger. But many don't. They chase and boom, zero balance. That's the turning point where self-improvement shines, learning from failure. I remember a story of a trader who lost $10,000 scalping, quit for a month, studied probability more like dice odds, came back with better risk rules, and turned it around to consistent gains. It's that shift from reactive to proactive mindset. Wrapping it up, scalp trading, explained through dice, shows it's a high-speed game of edges, risks, and quick choices. It's the fastest way to win big if you master probability, discipline, and emotion control, but also the quickest to lose if you treat it like pure luck. The key takeaway for self-improvement is building habits like patience, planning, and bouncing back from setbacks, skills that help in trading and beyond. Remember, start small, learn the ropes, and always protect your capital. If this clicked for you, hit subscribe for more breakdowns like this.